We're joined by Mahesh Patil, Chief Investment Officer for Equity at Aditya Birla Sun Life Mutual Fund, and he'll be sharing his inputs on the subject. Mahesh, always a pleasure to speak with you, and thank you so much for joining us. I'll start by looking at the broad picture. Uncertainty was the buzzword for 2 years owing to the pandemic, and as we cut to 2022, now the macroeconomic environment looks dampened with inflation plaguing even developed economies. So, given the prolonged climate of volatility, Mahesha, what should investors do to stay on track with their financial goals without deviating from their risk bandwidths?
Yeah, good afternoon, Gautam, and pleasure to be on this platform. So I think we have seen unprecedented uncertainty, volatility, or whatever ambiguity as you call it, in the last in this calendar year, and this is during this time it is where investors need to really stick to the discipline, stick to their asset allocation, stick to their investment goals, what they have planned, and continue with that because normally when we see that when there is gloom and doom around, when there is a lot of pessimism as there was around 2 3 months back after the Russia-Ukraine conflict came out, everybody thought that the markets are going to go down further. Okay, there is no bottom to the market, and invariably, while the conditions still continue to remain uncertain, but markets, in its own wisdom, has also bounced back. So I think in this kind of a situation, when there is volatility, I think it's very important to stick to your discipline of what is the asset allocation you had planned, depending on your risk profile. Say, for example, at the beginning of your asset allocation, if based on the risk profile, if you are targeted that 50% will be equity allocation, around 40% could be debt, 10% could be gold, then when there is volatility and when the particular asset class, for example, in this case, when equities fall down because of global concerns, then one need to really rebalance that at regular intervals. Now, the intervals can vary depending on, say, monthly or quarterly period, depending on what your financial advisor will advise. But really stick to the plan and continue with that, because what we have seen is that those periods of uncertainty and volatility don't remain. And when the dust settles down, the particular asset class, whether it's equity, where the volatility is higher, it again bounces back. So I think not deviating from your target asset allocation plan and doing a regular rebalancing and adjustment, I think is what investors should do in this volatile times. And if they do that, then automatically they tend to benefit because whenever a particular asset class goes down, then one tends to add that at a bottom rather than chasing returns.
All right, taking forward, Mahesh, what you said about sticking to the plan despite volatile times, according to you, what are the pitfalls to be avoided by investors who may still be, say, recovering from the economic fallout unleashed by the pandemic?
So this last 2 years has been pretty eventful and also harsh on individuals because of the one was the pandemic. There could have been job losses, there could have been salary cuts which have been there, and also people have seen at point in time when the markets were down, their wealth would have got eroded if there was into equities. And ironically, we also saw that even the investments in the bonds, because as interest rates went up, okay, also got impacted. So in this situation, I think it is important that when your incomes get impacted because of economic slowdown or salary cuts, that's the time where you should first dip into your short-term savings. Then, if at all you need to really take care of your needs, then cut down on your discretionary spend, like for example, which can be deferred. For example, if you wanted to buy a house or a car or any other consumer durable, which can be deferred for some time. But I think one should not really dip into your long-term savings, okay, which one has planned, because that's the time when the value of the asset or is the best. And if at that point in time you dip into, normally there's a tendency to sell. Like for example, when equities went down during the pandemic, a lot of investors thought, okay, there is no end to it. and wanted to have some financial security, they would have sold their equity investments, and in turn jeopardize their long-term goal, because then the markets also bounce back very sharply. So I would say that first dip into your short-term saving, then try to curtail your discretionary expense, and try to keep your investment plan, which is the SIPs and other which you have planned for your long-term wealth creation, for your long-term goals. I think that should be the last one which one should be touching, because invariably we've seen that there is a normalization which happens. There's a mean reversion which is there, and that should take care. And when things are okay, then one can take out some money to really then spend into for your other short-term needs.
All right. In terms of the long term wealth creation equation, debt also plays an important part. So let's look at that side of the equation. In the current landscape where market volatility seems to have very strong hues, and we are seeing a period of interest rate fluctuations and rate hikes coming in. So, in your opinion, how should debt instruments be placed in one's portfolio?
So, I mean, after the pandemic, what we've seen was a lot of investors, because interest rates came down sharply. The central banks cut interest rates to stimulate the economy, and short-term rates, fixed deposit rates also came down significantly. And in that period, there was overwhelming diversion towards equities, and debt for the fixed income was kind of an ignored asset class to a large extent. I think now again, considering the volatility what we are seeing on the equity front, and also the fact that now central banks on the back of rising inflation, which is fairly stubborn, is starting to increase interest rates. We have seen RBI also increase interest rates by around 125 basis point recently, and that has led to increase in the overall short-term rates. Okay, so the returns on the short-term liquid funds, which was around 3 to 4%, now that is looking much better, around 5 to 6%. And even in terms of the, if you look at a 10-year bond yield, is now around 7.3. So now debt as an asset class looks fairly decent. The risk reward is fairly good, and one should not ignore that. Should be again as a part of your asset allocation, depending on what you need to, depending on a risk profile. So I would say that if people had investors had over invested into equities because interest rates were low and taking that kind of a higher risk, I think needs to be corrected now, because now debt and fixed income instruments are slowly starting to yield better returns. Still not really beating inflation, but I think over a period of time, you should see inflation kind of normalizing. We think inflation has peaked out over here. We've seen now commodity prices starting to come down, and because of global growth is also now getting impacted, the demand side, demand for goods and services will go down. So inflation should start to peak out, and interest rates also, there are further rate hikes, okay, which the RBI will do to really contain inflation. We expect another 50 to 75 basis point rate hike, which will be there. So in the next few quarters, I think you will see the returns on fixed income also start to look relatively attractive on a risk-adjusted basis, and that should clearly be considered as an alternative, okay, depending on one risk profile to really balance in the overall portfolio.
All right, those are some reassuring words, especially from the debt side of the equation. In fact, for those investors who track the markets closely, they do see green shoots emerging. We have seen healthy earnings, FIIs are returning, auto sales numbers look good from the equity side of the equation. And now, as you mentioned, there is some recovery being seen in the debt side of the market. But let's also look at investors who are very low risk appetites, right? And we're not tracking the markets closely. And they find themselves in a predicament. And that volatility broadly in capital markets is discouraging them from investing in equities, while, say, soaring inflation is pinching returns from fixed income and debt instruments. So, in your opinion, Mahesh, what is the ideal course of action for such investors?
So, Gautam, you're right. I think while one want people afraid of volatility, and you tend to invest into debt, and one should look at it, but really for long-term wealth creation, and to really hedge for inflation from a long-term perspective, you need to have a right mix across asset class. And each asset class has a different long-term return. Like by equities, if you look at the long-term returns, would be around 12 to 13%. Gold would be around 8%. Real estate would be around, again, similar to 8% or so. So it's important to have a portfolio approach. So in the market, there are various products which are there which tend to uh, um, uh, they tend to take advantage of the long-term return of various asset class. At the same time, provide an ideal mix for investors so that the volatility is reduced. So some of these funds are like the balance advantage funds, which are there, which is a combination of investing into debt and equity, and where the equity allocation varies depending upon the attractiveness of the market, depending on the relative valuation in the market at any point in time, and tries to do that asset allocation on a dynamic basis. And that tends to reduce the volatility for investors, at the same time giving them better returns than what fixed income or better than inflation. Also, there are other products which invest across various asset class, okay, besides debt and equity, into commodities, into gold, and try to reduce, further diversify and reduce the volatility. And we know that all asset class, there is some kind of, they're not all correlated. So when equities don't do well, gold normally tends to do better, or fixed income could do better. So that balances out. And on an average, the investors can get return which is average of the total asset class proportion in the asset allocation which is there. So there are these various hybrid funds which are there, which investors can look at, which normally over a longer term give returns much better than inflation, somewhere near the double-digit returns. At the same time, they reduce volatility. So for investors who are really worried about volatility, at the same time looking for some better returns long-term than inflation, then some of these hybrid products, asset allocation fund, the balance advantage funds, would be the ideal products to invest into.
All right, expanding on that thought, you mentioned about the benefits of balanced advantage funds, but let's also look at the goal aspect of investors. They have short, medium, and long term goals. So, from that perspective, Mahesh, what kind of funds would you advise for investors to prefer in this current climate for their short, medium, and long term goals?
So in the current environment, we believe that the risk reward across asset class, whether it is equity, whether it is fixed income, or whether it is any other asset class, say for example gold, is fairly well balanced. I mean, what I mean by that is that nothing is like totally mispriced, right? Where you would go aggressively and want to invest. Equities also, if you look at currently, they are quoting at around their long-term average valuations in terms of price to earnings multiple. So they are fairly valued, and you can get the long-term returns over there. So in this kind of a scenario, for your short-term needs, I would say it's best to put money into very liquid instruments. So on the mutual fund side, you can look at a liquid fund or a savings fund, okay, which could be, or a short-term fund, which would take care of the needs, because then one is not playing the interest rates risk which is there, because we still believe that interest rates could go up a bit. And so you should match your duration, okay, of that fund, in a, especially in the fixed income, to your investment horizon. If you do that, then you're protected from any loss or mark to market loss because of increase in interest rates. So for short term needs, as I said, your liquid fund, savings from a short term fund. For a medium term goal, say, which is for the next, say, 1 to 2 3 year period, there one can choose a combination of debt and equity funds. So on the equity fund, one can look at the hybrid products like the balance advantage fund, the asset allocation fund, which can look at even a large cap fund can be looked at to some extent. And on the debt side, one would recommend the medium term plan, or there are now new funds which have come into the marketplace, which is the index based debt funds, okay, where the investment horizon of the fund is matched. Okay, the underlying instruments are matching the investment horizon of that fund. And these are very fairly attractive investments at this point in time, where the returns are around 7.5%, and they're investing into sovereign bonds. So that those kind of funds can be looked at if you're looking at a fixed return. Okay, though that can be a very attractive investment for medium term kind of an outlook, which is typically a, say, 1 to 3 year time frame. And anything beyond for a long-term wealth creation, I think equities still offer the best risk reward. Even from here, despite the global concerns, despite the geopolitical risks which are there, despite high inflation, we think that Indian economy is poised for a decent recovery and a good long-term growth. And equities over a longer term will give you their whatever long-term returns, average returns, what they are delivered in the past. And that for that long-term wealth creation, one can look at, I mean, the large cap funds, the flexi cap funds, the multi cap funds, or and even to some extent the mid and small cap funds, because while current volatility could mean that the risk in the small and the mid cap could be higher, but if Indian economy has to do well, then there are a lot of mid and small cap companies which will do well over the longer term, and one can look at those funds. But again, uh, uh, one should stick to the discipline, right? Typically, the asset allocation, what we are advocating at this point in time, if we're investing for long term into equities, would be around 25% in the large cap, around 35% into a flexi cap, another 20% can be in a mid and small cap fund, and then balance could be any thematic funds.
All right, that's the formula for wealth creation. And as Mahesh mentioned, it is important to stay in the game. And as we see periods of adversity, remember, they also bring forth opportunities, but it's important to maintain that discipline. Mahesh, as we look to conclude our conversation, I want to bring this point that, financial experts have touted time and again that periods of volatility, they can bring forth excellent opportunities for investors to buy stocks that could have been considered expensive earlier. So, in your view, what are the things that investors should keep in mind when exploring such opportunities?
So I think always an investor, especially a long-term investor, should consider market volatility or any market correction as its friend, because that's the time when one is able to buy stocks probably below their intrinsic value and at a very attractive valuation. And we know bad times don't last. I mean, history has taught us there have been many events in the market where we've seen large corrections to the tune of around 50-60% during the global financial crisis. And if you look at a year down the line or 2 years down the line, markets have again bounced back from those levels. So, investors should realize the situation, whatever uh, uh, the concerns or the bad situation don't really last for long. Even the current geopolitical risk, what we are seeing, history has told us that these events don't really last for too long. And the only thing invest, and so when there is a market correction, a deep correction, that's the best time to really scout for opportunities, or probably time to increase slightly higher allocation to equities. One is trying to invest into stocks, I think one caveat I think one should keep in mind is that people tend to look at stocks which have fallen the most and try to invest that. But I think overall experience has taught us that in the when you come out from a bear market to the bull market, some of the weak companies, okay, which are there from the previous bull market, they don't really come back. So it's always the first thing to invest in a market correction is to invest in the good quality companies which have had an established track record, because these are the companies which are going to bounce back first. Okay, when the market situation improves, they're going to also get advantage. Okay, because during downturn, the large we have seen the bigger and the larger companies tend to even gain market share. So stick to good quality companies, good management, and if you do that, I think, I mean, this is the best time to buy, right? Whenever there is a pitfall, a correction in the market, that's the time to buy good quality companies, good management at a reasonable valuation. Because normally in a kind of a bullish market or the market what it is currently, you will not get them at your price, right? And that's what I endeavored in the portfolio when we're managing funds is to really look at some of these good quality stocks which can be bought at a reasonable valuation. And that's what investors should do it whenever the market provides that opportunity.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme related documents carefully.